All right, so today we'll try something a little bit different, see how it goes. Welcome everyone. I'm Sean McKay, aka the Lousy Investor. And so typically when we've done Lousy Investor content, it's just simply been me speaking into the camera. But today's an interesting topic. We're going to talk about whether it's a good time to be investing in real estate. And so I do have a number of things that I want to cover and I want to discuss. The first thing I want to talk about is just simply where we are and kind of the reasons behind that. And so ultimately, if we're watching this in kind of current time, so let's say that you're watching this video in November of 2022, we realize that we're effectively in kind of a transitioning market. And so we've kind of seen the peak of this cycle of real estate. And we understand that things are probably going to continue to deteriorate to a degree. So we think that there's probably a rational argument to be made that the prices will be coming back, perhaps significantly. And so to me, the biggest reason behind that is the interest rates in the marketplace and the interest rates if you're going to get a real estate mortgage. And so ultimately, if we look at the year 2022 that we're in now, we see that we started the year and we were looking at roughly about a 3% interest rate for those that are going out into the marketplace, borrowing money typically from a bank in order to get a mortgage on a property. And so we started the year at 3%, and we're currently hovering just over 7%. And so that's pretty significant when we look at that. And so if we put that in terms of kind of a real life scenario and what that looks like, it's easy to see how we're starting to see a softening in the real estate market. And so I just ran some really basic numbers this morning about what that looks like. And so let's say that you go to a mortgage broker and you say, okay, here's my financials. Tell me how much house I can afford. And so with that, they're going to run kind of a debt to income. They're going to look at what you're making in your job. And they're going to say, okay, let's say you can afford somewhere around a $1,600 or $1,700 a month monthly payment. And so what that's going to look like is if we're in a 3% marketplace like we were at the beginning of the year, if you're going to buy, or I should say, you're going to borrow 400,000 from that bank at 3%, that's going to run you 1686. So $1,686 in terms of a monthly principal and interest payment. And so we carry that forward to today's reality. So if you're going and you're looking in the marketplace to buy a house, and you have that same kind of debt to income structure where you can borrow, again, somewhere around $1,700, you're only going to be able to borrow $250,000 at a 7% interest rate. So again, the same buying power, if you will, before at the beginning of the year, you could borrow 400,000. Now you can borrow 250,000. So that's pretty stunning. And that's certainly something that we're going to have to just kind of be aware of and acknowledge, because certainly the Fed is telling us, hey, inflation is out of control. We're going to continue to hike the interest rates as much as we feel like we have to in order to get this all under control. And so that's really the honest reality of where we are and where we're going. And so the next thing we're going to look at and we're going to discuss is the idea of where we are now relative to 2008, because a lot of what we're hearing out there from different pundits, from hedge funds, from just people in our lives is that real estate's going to have a crash like we had in 2008. And so certainly I don't have the answers. Nobody ultimately has the answers until things play out. But as Mark Twain said, and I'm going to kind of not get this exactly correct, but it was something to the effect of history doesn't repeat itself, but it often rhymes. And so I think if we break down the mechanics of how we got through the 2008 concept and how that compares to today, that might give us a little bit more understanding of perhaps where we're going in the marketplace. And so when we look at the massive price increase leading up to the 2008 scenario, I would say that that's fairly similar to what we've seen the last few years leading into the softening of the real estate market that we're all experiencing in 2022. So I'd say those are pretty similar in nature. ultimately, there has been elevated investor activity in both of those environments. I grew up in Florida, and so certainly Florida was one of those extremely dynamic markets, and one in which it's kind of a leading indicator of what's happening in the national market. And so ultimately, I started investing in real estate in 2002. So I was a part of this group of newer investors that certainly in my case, didn't really know how to handle certain economic environments. And so there was a lot of mistakes that I made. I don't blame the 2008 meltdown for losing value in properties that I owned. I just simply did poor analysis and I didn't understand cause and effect of how things worked out. But I would say that those things are fairly similar in nature. But I would say one thing that's very different in this 2002 environment versus the pre-2008 meltdown is that we've seen extraordinary investment from institutional buyers. So we're talking about Wall Street money, we're talking about hedge funds. That's a dynamic that we did not have pre-2008. Now, I don't know if that means that that could exacerbate any sort of issues we have in the real estate marketplace, but that is a very different dynamic. And so what's interesting about that, though, is we all got to see the movies, The Big Short. And so on the back end, there was a lot of packaging of these bank products. And so there was a lot of easy money on the front end, and there was a lot of kind of extravagant or unusual loan products that were being put out there in terms of adjustable rate mortgages. And something that wasn't talked about as much and wasn't quite as prevalent, but to me was a much more dangerous loan product, was a negative amortization. So with a negative amortization, the way that that works is you buy a property, and let's say you borrow $100,000 for that investment property. As you move forward, in an effort to keep your payment low so that it will hopefully cash flow for you as the owner, the loan product is set up so that each year you actually owe more money against that property than you originally did. So in year 2, you might owe $101,000. Year 3, it might be $102,000 or $103,000. And so that's certainly a very dangerous product, because one of the great things that everyone talks about with real estate leverage is the ability to have your tenants pay off the loan. Well, the tenants are paying you money, but in this case, they're not helping you pay off a loan with a negative amortization. So thankfully, the adjustable rate mortgages, we've started to see in the last 12 months that product coming online, but that hasn't been nearly as prevalent leading up to the softening of the real estate market as it was pre-2008. So I think that's very different. Now, what's different that kind of the 2022 environment we're living in has had as a part of the equation is that the interest rates have been hiked up far more quickly than we can remember in recent history. So again, we've kind of 2x plus in the year 2022. We started at 3%. 2x obviously would bring us to 6%. We're over 7%. And there's not really any sort of guidance stating that we're going to level off or that interest rates are going to be coming down in the near future. So different dynamics, some similarities, some differences, but ultimately, again, history might rhyme. I certainly don't know if we're going to have a 30, 40+% pullback, as especially we did in some of the markets like Las Vegas, Nevada, California, Florida, et cetera. So just some things for us to kind of digest as we're going through this process. Now, for me, as I think about how we plan for this time, there's a number of things that we can do as real estate investors that either currently own properties or we're looking to get into the real estate game. And so obviously the discussion today is now an opportunity for us to buy as the market is just starting to soften. And so I really think it's important for us to take inventory personally and for us to look at our weak spots and see where we are financially, where we're trying to go, and put this whole puzzle together. And so the first thing I would say, the beauty of my job, my day job in financial services, is that I have the opportunity to interact with a large volume of investors, and many of them are real estate investors. And what I typically see and what I hear in conversations is, unfortunately, so many of these investors are incredibly optimistic about the stability of the investments that they own. And so they don't find it necessary to keep significant cash reserves to deal with issues because they're very positive on the way that the market is going. I was in a breakfast real estate meeting where an investor who is a lovely individual, but he's been investing in real estate for the last couple of years, and it's certainly gone well the last couple of years. He stated that he didn't see any way that the real estate market could have any issues for the next 10 plus years. And I think that that was a really aggressive statement, quite frankly, because it is so difficult to forecast what the next 12 months will look like. And so to go that far out and to be making financial moves based on that level of confidence with such a long-term time horizon, I certainly don't have that confidence. Perhaps some of you do. But I think one thing that we can look at is if we currently own rental properties, before we go out there looking for new acquisitions, I would ask that you at least consider the idea of really bolstering your cash reserves. And so everyone's going to have a different metric. I'm not saying that mine is the best, but again, in the last 20 years now of owning rental properties, I think one thing that has helped me to sleep well at night is having about $10,000 per door set aside in reserves. And this is in addition to personal reserves. So, you might be a fan of a Dave Ramsey or a Coach Carson that talks about kind of your personal financial situation where you want to keep 3, 6, maybe 12 months of reserves in case, let's say, you were to lose your job. And so this would be in addition to that. So you might have $20,000, $50,000 plus of personal cash reserves for that kind of rainy day and things going wrong in your business life. But in your real estate investment life, I would ask you to consider on top of that about $10,000 per door. So if you own 5 rental properties, you're looking at $50,000 for your real estate investments to hopefully kind of solidify any sort of worst case scenarios. And so certainly if a tenant tears up a property, if you're needing to work with banks to kind of refinance some properties where maybe you don't have great debt on them currently, you've been in kind of acquisition mode and doing what you have to do to get these deals done, this is a time to perhaps look at your financial situation and see what we can do in an effort to kind of bolster and make sure we're going to be steady. Because obviously growth is great. We're all about growth. We're all about creating cash flow. We're all about creating financial freedom. But part of financial freedom is making sure that we can deal with the downside and not always just purely thinking about the upside. So as I think about debt structure, as I get older, as I have experiences, as I get to learn from fellow investors in the real estate community, I'm becoming a bigger and bigger fan of free and clear or paid off rental properties. I never thought I was going to be that person. Before my wife and I got married, I famously told her that my goal over the next few years is for us to have an additional $1 million in debt, which coming from the conservative financial background that she did with her family, that was not the right thing to say. But my thought was, well, if you owe $1 million, then ultimately, if you can get that $1 million paid off over the next few decades, you own at least $1 million in rental properties. And the math works out on that, but ultimately paid off rentals, especially again, as you get older and you see the downside as well as the upside with owning leveraged investments, that can certainly help a lot of us sleep well. But you may or may not be in a position to pay off rentals. I understand that. So plan B in my mind is to look at opportunities to have non-recourse debt. And with that, non-recourse debt simply means you are not personally guaranteeing the debt. So the bank or the individual that is lending you the money understands if the world collapses, if we have another 2008, if we have another scenario that's perhaps even worse than that, if you're unable to keep this property going, you're not able to keep it filled with tenants, or tenants are consistently tearing the property up, maybe unfortunately you get let go from your job, all these things are kind of compounding for you. It's a scenario with non-recourse debt where they can't sue you personally for any sort of default or foreclosure, they can just simply take that property back. And so it kind of gives you a little bit of safety for the worst case scenario. Now, again, as real estate investors, we're all about growing our portfolio, not about giving properties back to banks. But it is a little bit of a stopgap in terms of the worst case scenarios there. And then to me, the plan C would be working on structures where you either A, do not have to worry about ever having to refinance. So you have a fully amortizing 30-year fixed loan, which is a phenomenal product, especially for those of you that have solid day jobs. This is a product where you never have to worry about the market conditions, what interest rates are doing, what price points are doing. You're locked into that loan and you can move on with your life. So if you were able to lock in a 3, a 4, a 5% interest rate, and let's say interest rates go to 10%, that doesn't affect you. That doesn't affect your payment on your investment property because you're locked in. Now, with seller financing, I like it for a few reasons. If you happen to be in a state like North Carolina is a state where if you get a seller finance deal put together, so you buy a property, excuse me, from an owner, and the owner is willing to finance that property to you, it is actually a non-recourse debt structure. So that seller, if again, you're unable to perform and keep that property going, can only simply foreclose and take the property and can't sue you or your company perhaps that owns that property. So that's an interesting concept there. In addition to the potential non-recourse aspect, there's also the ability perhaps to renegotiate if things change. And so again, if our economy goes into a tailspin and things are really awful for the next few years, and let's say that the job market is so brutal in your metropolitan area that rents are really coming back as well as prices are, it's possible that you might be able to go to that seller and say, listen, I realize we put together a seller finance note at 6% interest or 8% or whatever it may be. But as you can see, the market has changed. I can't continue to pay. So would you want for me to give you a deed in lieu? So basically give you this property back? Or can we renegotiate the terms where at least for the next few years, I can pay less interest so that I'm able to keep this property going and I can still pay you cash flow each month as the lender on this deal. So it gives you perhaps the ability to have a conversation with the individual as opposed to some big, large bank that's likely not going to be as keen on negotiating with you. And so that brings me to the last point here, which is if you are one of those people that's a big fan of commercial loans, and so you're kind of getting shorter loan products where it's amortized over, let's say, 20 years, but there's a balloon in 5 years or 7 years, and you're a number of years into this, this is perhaps the opportunity for us to look at some options for us to refinance our properties into 30-year fixed products. Because again, interest rates might continue to go up. If prices continue to go down, there's no guarantee, and this is one of my biggest pet peeves, so many investors that have come in over the last few years think that it is a guarantee that they'll always be able to refinance into another loan. But in 2008, 2009, I watched so many people struggle and ultimately, unfortunately, many of them failed to be able to refinance. And so banks were foreclosing, taking properties back, et cetera. And so I don't want to see anyone have to go through that. So if you're able to lock in 30-year fixed financing and the property can still cash flow for you, that's perhaps, again, something that we may want to consider. And so what do we do in this marketplace? How do we invest? How do we pivot? Where are the opportunities? And the great thing about investing is that if we talk to enough intelligent people, if we look at it from a variety of angles, there's many times opportunities regardless of where we are in the market cycle. And so again, understanding the market is softening. Almost every metropolitan area is definitely seeing the days on market starting to expand. So properties that were selling in 2, 5, 10 days are now taking 20, 30, 40, 50 days to sell. The average price might be coming down slightly in your metropolitan area. Interest rates are rising. So there's a lot of reason to believe that the market is going continue to soften. And so ultimately, my view, the way I am preparing for my personal real estate investing is I'm being very, very careful about short-term investment opportunities. And truth be told, full disclosure, I've never really been a big proponent of flipping houses. I do not have the skill sets or the time to devote to uh, owning a new build project and kind of being effectively the GC for that. That's not in my wheelhouse. And so as someone with a W-2, that's something where it's not really a big interest for me anyways. But short-term investments, again, if the market continues to go down, boy, you're really going to have to buy that right to fix that property up and still make a profit as the market's going against you. So I would really caution those of you that are in that realm to be at least really conservative with the way that you're underwriting that moving forward, because until we see some sort of kind of flattening and the interest rates coming back, that might be a really tough game to play. Now, ultimately, the things that I'm focusing on right now are doubling down on relationships. And so it's been a wild few years. And so what you've seen is so many of your vendors in construction that have been going on to really lucrative products. So they're latching on to spec properties. They're latching on to working with kind of the smaller builders and sometimes the tract builders, but they have a capacity to make a lot of money in a real estate market where there's just lots of opportunities to do lots of business. And so with that, their prices have gone up 2-3x in a lot of cases over the last 4 or 5 years. And good for them. You got to get it while the going's good, right? But it's time to revisit those relationships and let them know you're still in the marketplace. And when the new builds go away or the flips go away, you're still going to want to do business with them. And also finding new relationships as well. The great thing about the real estate industry and in construction is that you see new players in the marketplace on a regular basis. And also, I'm doing a lot of networking with investors. And so it's great now. There's virtual worlds out there, things like Bigger Pockets. There's local real estate investment groups that you can join. And so you want to be networking, you want to be sharing ideas about how to go about looking for opportunities, because ultimately, if you really boil down the discussion today, at least in my humble view, I think that it's been really difficult to find obvious opportunities over the last couple of years as the market has just been going nuts. There's been so much optimism and confidence from sellers that they're going to set the new price point in their neighborhoods. And so that's phenomenal. There's been a lot of good money made by a lot of people over the last few years, but the macro environment hasn't been an obvious buying opportunity. I've largely been a net seller of properties over the last few years, but I'm always looking to, just generally speaking, expand the portfolio. And so again, the macro isn't incredibly fruitful, in my opinion, as to where we are right now. But I think that there are significant opportunities in the micro. And so what I mean by that is this. Let's say that if you look at statistics for the national real estate market, things have leveled off. And so the price points, just on a very broad stroke basis, we haven't seen any significant deterioration in terms of the marketplace, and $400,000 houses being worth $300,000. Now, of course, there are some markets like California, some pockets of Florida where I have family that there's a little bit of deterioration there, but the macro is at the moment pretty level. But the micro is where, as real estate investors, there's always opportunities, and I think where we can really start to focus. And by that, what I mean is that let's take Charlotte, North Carolina. That's where I live. That's where I invest. And so Charlotte has been one of those top 5 and certainly top 10 markets over the last 5+ years, where there's been mega appreciation. There's been a tremendous amount of investment from hedge funds. And so there's been a lot of appreciation. And so anyone that's owned a few properties thinks that they're incredibly intelligent because of the investments that they've made. We've just been in a great macro environment. But the micro, in my view, is that there are going to be opportunities with specific houses, specific duplexes, specific parts of town that things are changing. So there could be scenarios where a certain neighborhood, for example, has been targeted by the investment community. That's considered a hot spot. That's where there's been a lot of flipping going on. That's where a lot of newer real estate investors have been buying rental properties. And unfortunately, just the way that capitalism works is that there are going to be winners and there are going to be losers. And so sometimes the people that were starting off winning, they don't have their cash reserves, for example. And so they have a tenant tear up the property and they're needing to refinance so that they can pull some of that equity out so that they can actually pay their bills on the property. We're seeing a lot of people over the last couple of years that have actually been very aggressive in their communication on social platforms about their houses are personal checking accounts, and so they can just sell properties or refinance whenever they want, and within weeks they have big chunks of cash. That's not happening so much right now. Those same people are really starting to panic, and they're publicly panicking, which is unfortunate on a lot of levels. And so what we're seeing is those people are stuck. They're stuck, and foreclosures are going to start to happen. They're going to start to be in a position where they're going to be open to selling properties. They're going to be open to different financing structures. There's going to be opportunities in the micro because, again, perhaps lack of cash reserves. It's a lack of understanding about how to maneuver in a softening market. It's really easy to own rental properties when the rents are going up substantially, when the value is going up substantially, and the bankers want to give you lots and lots of really cheap money. But ultimately, people are going to lose jobs as well. There's unfortunately typically an upswing in terms of divorces because of financial situations and otherwise. And so there will be owners, there will be investors that are going to need to exit their properties for a variety of reasons. Maybe they need to leave the area to get new employment. And so the micro, there will absolutely, and there are absolutely opportunities for us to identify something that makes sense for us. And so as we're networking, as we're talking to contractors, it's a great time for us to kind of renew our intensity for understanding the neighborhoods that we invest in, because I'm the first one to tell investors as we're having conversations, even in Charlotte, North Carolina, there's entire parts of the city that I don't invest in, and I don't understand that local dynamic there in the certain neighborhoods. And so they're just a pass for me. It could be what other people would deem to be a great opportunity, but I try to be really locked into the certain neighborhoods that I think make sense for owning rental properties. And so I want to be able to, when I'm presented with a potential opportunity, whether it's from a homeowner or from a wholesaler, I want to be an expert so that I know how to analyze that confidently and quickly. Because what you'll find when you're networking with wholesalers is many times they start with trying to sell to the highest bidder, but the highest bidder sometimes is unable to perform. And they only have a certain period of time in which they're able to make money by controlling the contract to sell that property. And so many times they end up having to come to a more seasoned investor that's confident, comfortable in that neighborhood, and can actually get that deal done. So even if they make less money, at least they still get to make money on transacting with you as that landlord that's going to own that property, operate that property, and has that ability to get that deal done. So just a little bit of food for thought. So if I were going to sum this all up, I would say not a huge fan right now in this part of the market cycle in short-term investments. So fixing and flipping, new builds, things like that. I think that we're going to see more and more obvious opportunities, but there are already opportunities with individual investments, houses, duplexes, quads. And that's something where, as small investors, we can still have a really productive year. And again, if we're able to utilize 30-year fixed financing and the property cash flows with the current economic dynamics, then even if the prices continue to come down, if we're in this for the long haul, we're trying to build a rental portfolio that can sustain us in our retirement years, or perhaps be something that gets us out of a job that we're not too fond of in the next 5 or 10 years, that's a big win for us. So definitely some things to consider. I know there was a lot to digest there, so hopefully there was something of value. So if you found us somewhere else, definitely feel free to check out our YouTube channel, The Lousy Investor. We do have content that we put out pretty regularly. We'd love to get some comments, some feedback in terms of what you want to see moving forward, what we can discuss, and kind of start a conversation around. Also, big thank you to American IRA, who's the sponsor of this video. They do self-directed IRAs and 401ks. And so that's the opportunity to use your retirement account to not just invest in the stock market, but to invest in real estate, to invest in privately held companies. So maybe you're interested in investing in someone's apartment syndication deal. That's something where you can participate through your retirement account. Maybe you're looking to buy a house or a duplex as an investment property. American IRA is a great resource for giving you the ability for your retirement account to acquire that investment property. So definitely feel free to check them out, americanira.com. So thank you guys so much for joining us, and hopefully we'll see you at another piece of content here soon.